The RBI MPC stands for the Reserve Bank of India's Monetary Policy Committee. It is a 6-member committee that is responsible for fixing the benchmark interest rate in India. The interest rate affects how much money is available in the economy and how much it costs to borrow. The interest rate also influences inflation, growth, employment, and exchange rate. The RBI MPC was established in 2016 by amending the RBI Act. The committee consists of 3 officials from the RBI and 3 external members nominated by the Government of India. The Governor of the RBI is the chairperson of the committee and has a casting vote in case of a tie. The committee meets at least 4 times a year and publishes its decisions after each meeting. The main objective of the RBI MPC is to maintain price stability while keeping in mind the objective of growth. Price stability means keeping inflation within a certain range that does not harm the economy. Inflation is the general increase in the prices of goods and services over time. The RBI MPC has a target of 4% annual inflation with an upper tolerance of 6% and a lower tolerance of 2%. This means that if inflation goes above 6% or below 2% for 3 consecutive quarters, the committee has to explain to the government why this happened and what it will do to bring it back to the target range. The RBI MPC also has other objectives such as stabilizing the business cycle, providing faster economic growth, ensuring exchange rate stability and generating employment. The business cycle is the periodic fluctuation in economic activity that goes through phases of expansion and contraction. The RBI MPC tries to smooth out these fluctuations by adjusting the interest rate according to the economic conditions. For example, when the economy is growing too fast and inflation is rising, the committee may raise the interest rate to slow down demand and cool down prices. On the other hand, when the economy is slowing down and inflation is falling, the committee may lower the interest rate to stimulate demand and boost prices. The RBI MPC also aims to provide faster economic growth by supporting productive sectors of the economy such as agriculture, industry, and services. Economic growth is measured by the increase in gross domestic product, GDP, which is the total value of goods and services produced in a country in a given period. The RBI MPC tries to create an environment that encourages investment, innovation and entrepreneurship by ensuring adequate liquidity, low cost of credit and stable exchange rate. The exchange rate is the value of one currency in terms of another currency. For example, how many Indian rupees can buy $1? The exchange rate affects the competitiveness of Indian exports and imports in the global market. The RBI MPC tries to ensure exchange rate stability by preventing excessive volatility or misalignment of the rupee against other currencies. The committee also considers the impact of exchange rate movements on inflation and growth. The RBI MPC also strives to generate employment by creating more opportunities for people to work and earn income. Employment is measured by the number of people who are working or looking for work as a percentage of the total population. The RBI MPC tries to promote employment by supporting sectors that create more jobs, such as small and medium enterprises, infrastructure, education and health. The committee also tries to reduce unemployment by lowering interest rates when there is slack in the labor market. These are some of the objectives and functions of the RBI MPC. By setting the policy interest rate based on an assessment of various macroeconomic factors, the committee aims to achieve a balance between price stability and growth while taking into account other goals such as exchange rate stability and employment generation. The Reserve Bank of India, RBI, is the Central Bank of India and it is responsible for maintaining price stability and economic growth in the country. One of the main tools that the RBI uses to achieve these objectives is the policy rate, also known as the repo rate. The repo rate is the interest rate at which the RBI lends money to commercial banks for short-term purposes. The repo rate influences the cost and availability of credit in the economy, which in turn affects inflation, consumption, investment, and growth. The RBI does not decide the policy rate on its own. It has a 6-member Monetary Policy Committee, MPC, that meets every 2 months to review the macroeconomic situation and vote on the policy rate. The MPC consists of 3 members from the RBI, including the governor, and 3 external members appointed by the government. The MPC aims to keep inflation within a target range of 4% with a margin of 2% on either side. The MPC also considers various factors that affect inflation and growth, such as global developments, domestic demand, supply shocks, fiscal policy, exchange rate movements, and financial stability. The MPC announces its decision on the policy rate and its stance after each meeting. The stance indicates whether the MPC intends to increase, decrease, or maintain the policy rate in the near future. The stance can be accommodative, neutral, or contractionary. An accommodative stance means that the MPC is willing to cut the policy rate to support growth and lower inflation. A neutral stance means that the MPC is not inclined to change the policy rate in either direction. A contractionary stance means that the MPC is ready to hike the policy rate to curb inflation and cool down growth. The MPC's decision on the policy rate and its stance has a significant impact on the Indian economy and financial markets. A change in the policy rate affects the interest rates on loans, deposits, bonds, and other financial instruments. A change in the stance signals the future direction of monetary policy and influences the expectations of consumers, businesses, investors, and traders. A lower policy rate and an accommodative stance tend to stimulate economic activity and boost market sentiment. A higher policy rate and a contractionary stance tend to dampen economic activity and weigh on market sentiment. The MPC's decision on the policy rate and its stance is not always predictable or unanimous. The MPC members may have different views on inflation and growth outlooks and may vote differently on the policy rate and its stance. The MPC may also surprise the market by changing its stance or its policy rate more than expected. For example, in June 2023, the MPC kept the policy rate unchanged at 6.5% but changed its stance from neutral to focused on withdrawal of accommodation. This indicated that the MPC was preparing to hike the policy rate in future meetings to contain inflation. The RBI's MPC is an important institution that shapes India's monetary policy framework and influences its economic performance. By deciding on the policy rate and its stance based on various factors, the MPC strives to balance inflation and growth objectives and ensure macroeconomic stability. Hello and welcome to this musical analysis of how the RBI MPC meeting affects the Indian economy. In this section, we will explore how the policy rates decided by the MPC influence various macroeconomic indicators such as inflation, growth, exchange rate, and others. The policy rate is the interest rate at which the RBI lends money to commercial banks. It is also known as the repo rate. The repo rate affects the cost and availability of credit in the economy. A higher repo rate makes borrowing more expensive and reduces the money supply. A lower repo rate makes borrowing cheaper and increases the money supply. The MPC adjusts the repo rate according to its assessment of the inflation and growth outlook. The MPC has a mandate to maintain CPI inflation at 4% with a margin of 2% on either side. The MPC also considers the impact of its policy actions on other macroeconomic variables such as GDP growth, exchange rate, current account deficit, fiscal deficit, and so on. Let's see how the policy rates affect these indicators with a catchy tune. Musical note: when the repo rate goes up, inflation goes down, but growth also slows down, and the rupee gets stronger. When the repo rate goes down, inflation goes up, but growth also picks up, and the rupee gets weaker. Musical note: now let's explain why this happens. When the repo rate goes up, it reduces the demand for goods and services in the economy. This lowers the inflationary pressure as prices tend to fall or rise less rapidly. However, it also dampens the economic activity as consumers and businesses spend less and invest less. This lowers the GDP growth rate as output and income decline. A higher repo rate also attracts foreign investors who seek higher returns on their investments. This increases the demand for Indian rupees and appreciates its value against other currencies. A stronger rupee makes imports cheaper and exports more expensive. This improves the current account balance but hurts the competitiveness of Indian exporters. When the repo rate goes down, it stimulates the demand for goods and services in the economy. This increases the inflationary pressure as prices tend to rise or fall less slowly. However, it also boosts the economic activity as consumers and businesses spend more and invest more. This raises the GDP growth rate as output and income increase. A lower repo rate also discourages foreign investors who seek higher returns on their investments. This reduces the demand for Indian rupees and depreciates its value against other currencies. A weaker rupee makes imports more expensive and exports cheaper. This worsens the current account balance but helps the competitiveness of Indian exporters. Of course, these are not the only factors that affect these macroeconomic indicators. There are many other domestic and global factors that influence them as well. The MPC has to balance these factors and choose an appropriate policy stance that achieves its inflation target while supporting growth. The MPC meets every 2 months and announces its decision on policy rates and stance. The latest MPC meeting was held on June 6 to 8, 2023, and it decided to keep the repo rate unchanged at 6.5%. The MPC also maintained its withdrawal of accommodation stance, which means that it is not inclined to cut rates further unless there is a significant change in inflation or growth outlook. The MPC cited several reasons for its decision, such as high headline inflation above its target, uncertain global economic conditions due to trade tensions and geopolitical risks, weak domestic investment activity, and possible impact of weather conditions on food prices. The MPC also projected a GDP growth rate of 6.5% for FY 2023-24, which is lower than its previous estimate of 7.2% for FY 2022. The MPC expressed its commitment to support growth while ensuring price stability. That's all for this section of how the policy rates affect the inflation, growth, exchange rate and other macroeconomic indicators of the Indian economy. I hope you enjoyed this musical analysis and learned something new. Stay tuned for the next section where we will discuss how the RBI uses other tools such as open market operations, cash reserve ratio, statutory liquidity ratio and so on to manage liquidity and monetary conditions in the economy. Thank you for watching and have a great day. How to use musical elements such as rhythm, melody, harmony and lyrics to explain and illustrate the concepts and effects of the RBI MPC meeting. Hello, music lovers and economy enthusiasts. In this video, I'm going to show you how you can use musical elements to understand and analyze the RBI MPC meeting that took place on June 8. The RBI MPC meeting is when the Reserve Bank of India's Monetary Policy Committee decides on the interest rates and other monetary policy measures to keep inflation and growth in check. The outcome of this meeting has a huge impact on the Indian economy and its various sectors. But how can we use music to explain and illustrate this complex topic? Well, music is a universal language that can convey emotions, ideas, and stories through sound. Music has different elements that work together to create a musical piece, such as rhythm, melody, harmony, and lyrics. Each of these elements can be used to represent different aspects of the RBI MPC meeting and its effects on the economy. Let me show you how. First, let's talk about rhythm. Rhythm is the word we use to describe when a sound should be played and how long it should last. It's the basic building block of all music. Rhythm is what makes you want to tap your foot or dance along to a piece of music. It's the underlying pulse that drives a song forward. We can use rhythm to represent the pace and direction of the economic growth in India. A fast rhythm can indicate a high growth rate, while a slow rhythm can indicate a low growth rate. A steady rhythm can indicate a stable growth rate, while a changing rhythm can indicate fluctuations or shocks in the growth rate. For example, we can use a fast and steady rhythm to represent the Q4 GDP growth of 6.1% in FY23, which was higher than expected and showed a strong recovery from the COVID-19 pandemic. We can use a slow and changing rhythm to represent the Q1 GDP growth of 8% in FY24, which was lower than expected and showed signs of slowdown due to rising inflation and supply chain disruptions. Second, let's talk about melody. Melody is a sequence of notes that create a recognizable tune. This sequence of notes is usually repeated throughout the course of a piece of music or song. The melody is another important element in a song, and it is often what people remember long after the music is over. A good melody is easy to sing or hum, and it stays in your head for days. We can use melody to represent the interest rates and other monetary policy measures decided by the RBI MPC. The interest rates are the price of money in the economy, and they affect how much people save, borrow, spend, and invest. The monetary policy measures are the tools that the RBI uses to influence the money supply and credit conditions in the economy. For example, we can use a high-pitched melody to represent a high interest rate, while a low-pitched melody to represent a low interest rate. A rising melody can indicate an increase in the interest rate, while a falling melody can indicate a decrease in the interest rate. A constant melody can indicate an unchanged interest rate. For example, we can use a high-pitched and constant melody to represent the repo rate of 6.5%, which was kept unchanged by the RBI MPC for the third consecutive time. We can use a low-pitched and falling melody to represent the reverse repo rate of 6.25%, which was reduced by 25 basis points by the RBI MPC to encourage banks to lend more. Third, let's talk about harmony. Harmony is when two or more notes are played at the same time. Harmony is what makes music sound full and complete. Harmony supports the melody and gives it depth and richness. We can use harmony to represent the balance between inflation and growth in the economy. Inflation is the general increase in prices of goods and services over time, while growth is the increase in output and income of the economy over time. The RBI MPC has to maintain a balance between keeping inflation within its target range of 4% plus or minus 2%, while supporting economic growth. For example, we can use consonant harmony to represent a balance between inflation and growth, while dissonant harmony to represent an imbalance between inflation and growth. Consonant harmony is when two or more notes sound pleasant together, while dissonant harmony is when two or more notes sound unpleasant together. For example, we can use consonant harmony to represent the inflation rate of 4.5% in FY24, which was within the RBI MPC's target range and showed a moderation from the previous year. We can use dissonant harmony to represent the growth rate of 6.5% in FY24, which was below the RBI MPC's potential output estimate and showed a slowdown from the previous year. Fourth, let's talk about lyrics. Lyrics are the words that are sung or spoken in a piece of music or song. Lyrics are what give meaning and context to the music. Lyrics can tell a story, express an emotion, or convey a message. We can use lyrics to represent the outlook and guidance of the RBI MPC for the economy. The outlook is the assessment and projection of the current and future economic conditions, while the guidance is the communication and expectation of the future monetary policy actions. For example, we can use positive lyrics to represent an optimistic outlook and guidance, while negative lyrics to represent a pessimistic outlook and guidance. Positive lyrics can indicate confidence, hope, and opportunity, while negative lyrics can indicate uncertainty, fear, and risk. For example, we can use positive lyrics to represent the RBI MPC's outlook and guidance for FY24, which stated that the economy is on a path of recovery, supported by favorable domestic and global factors and that the MPC will continue to maintain an accommodative stance as long as necessary to revive and sustain growth on a durable basis . We can use negative lyrics to represent the RBI MPC's outlook and guidance for FY23, which stated that the economy is facing significant challenges from the second wave of COVID-19 infections and that the MPC will remain vigilant and ready to act as appropriate to mitigate the adverse impact of the pandemic . So, there you have it. How to use musical elements such as rhythm, melody, harmony, and lyrics to explain and illustrate the concepts and effects of the RBI MPC meeting. I hope you enjoyed this video and learned something new. If you did, please like, share, and subscribe to my channel for more musical analysis of economic topics. Thank you for watching and see you next time.